Well, welcome to the webinar hosted by Catholic Investment Services. Thank you for joining us today for our annual Macroeconomic Outlook program. My name is Tom Lanctot, and I'm privileged to serve as Chief Executive Officer of Catholic Investment Services. My colleague, Zayla Starjan, has done a great job organizing this program and is at the Zoom controls. Catholic Investment Services was founded by some of the investment industry's most respected leaders to address the investment challenges faced by Catholic organizations. We are a Catholic nonprofit providing investment solutions for other Catholic nonprofits and their investment consultants, and now manage almost $1 billion of client assets in 4 different strategies. Enormous thanks to our Hall of Fame panelists, who you'll meet shortly. Today's format will be conversational. There will be time for audience questions during and after the formal part of the program, so please use the Q&A feature on your Zoom screen to submit a question. Our audience is muted. The program is being recorded and will be available for replay on our CIS Institute webpage and in podcast format. You received biographical information for our panelists, but I want to emphasize a few highlights. As many of you know, CIS founder and board chair Scott Malpass is the retired chief investment officer of the University of Notre Dame, where for 32 years he was responsible for investing the university's endowment and other assets. Notre Dame's endowment is one of the largest private university endowments in American higher education and the largest at a Catholic university. Institutional Investor magazine has called Scott an investment titan and MVP, and he certainly is all that and more for CIS. Scott will be our moderator today. CIS has been privileged to partner with Mario Giannini and his Hamilton Lane colleagues on 2 CIS Catholic Impact Funds and our CIS Catholic Venture Access Fund. Hamilton Lane focuses exclusively on private markets and manages or supervises more than $823 billion in assets. Mario is a talented musician who performs, I think this is still true, Mario, performs with the aptly named company band, the Hamiltones, and he also sets the tone for a very positive corporate culture that has benefited CIS and its investors. Mario attributes all of his success to his training at Boston College Law School. Joe Davis is Vanguard's global chief economist, global head of its investment strategy group, and chairs Vanguard's strategic asset allocation committee. Joe is a frequent keynote speaker and regularly contributes to academic and financial publications, such as his very interesting column in today's Wall Street Journal. Joe, we appreciate the timing of that to coordinate with our webinar today. Jesuit trained at St. Joseph's University, Joe earned his PhD in economics from Duke. So if these guys don't know what's going on, I don't know who does. Scott has to be here, but Mario and Joe, please know how grateful we are that you're with us today and you're taking so much time out of your schedule. Before we begin our program, please join me in a short prayer. Dear God, please grant us the serenity to accept the things we cannot change, the courage to change the things we can, and the wisdom to know the difference. As always, we pray for peace and civility and offer prayers and thanks for the women and men religious, their lay colleagues, and so many volunteers who, through their work for Catholic ministries, have devoted their lives to something bigger than themselves. Amen. Scott, all yours.
Thank you, Tom, and good afternoon to all of our clients and friends out there. I also want to say that I've had the great privilege of working with Joe and Mario in my various roles over the years, and I'm just delighted to be with them today to have a conversation about the global economy. So let me just start by just stating the obvious, how difficult 2022 was for investors. Most of us will be glad to put that in our rearview mirror. The capital markets were very unkind to investors. And of course, inflation was one of the key headlines for the year. And it was just anything that could create inflation did, whether it was money printing or supply chain bottlenecks, or some would say a very slow response from the Fed. And the subsequent rise in rates really impacted the equity and fixed income markets. In fact, a 60-40 investor had a very challenging year last year. It was probably one of the worst years in history for a sort of plain vanilla 60-40 investor. I think the first 3 quarters of the year last year were among the worst over the last 100 years or so. The encouraging news is that after a year like that, historically, things were a little more positive. So we're hoping for the best this year. We know that interest rates went up above 4% if you look across the Treasury yield curve, which made it a very challenging year for fixed income. So much for a risk-free asset. We get reminded of that every now and then, but that was very hard for investors. Of course, stocks went into a bear market in 2022, and in particular, some of the higher flying technology names, including many iconic names, had a severe correction, many losing up to 75% of the value in their stock price. The PE on the S&P probably peaked around 30 times and is now back to about 18 times, which is still a little above the long-term average of 16 times. So viewed in this way, many of the prior excesses leading up to that have been reduced, but there's still many challenges, which we're going to talk about today. In fact, according to the Philadelphia Fed, nearly 45% of economic forecasters are calling for a recession in the next 4 quarters, which I believe is one of the highest ever predicted ahead of a recession. So let me just maybe turn it over to Joe Davis from Vanguard, who I get to work with. I'm privileged to work with as a director at the company. And maybe, Joe, just take us through some of the things that are on your mind, a little bit of your outlook and some of the key indicators that you're following.
Yeah, thanks, Scott. And thank you, everyone. And I'm really honored to be here and to join the stage with Mario and Scott. And again, when Scott asked me to present to this august group, I just jumped at the opportunity. So I'll just have a few brief remarks, maybe just the level set in terms of thinking about the current environment. Scott mentioned, some of the big three: growth, inflation, and interest rates, and how they will evolve will dictate the outcome, the financial markets as well for the next several years. At a very high level, the very painful rise in inflation that we had, our expectation continues to be, and it has been since late last year, is that we would see a sharp drop in inflation over the course of 2023. Not because it was transitory and it was all supply related, it wasn't, but in part because central banks, particularly the Federal Reserve, became more focused on it, which is something I was concerned about a year or two ago. The labor market was tighter than I think they thought. But the good news is it came with market volatility, as Scott mentioned, certainly last year. But ultimately, if we can get inflation under control, that is a clear positive for long-term investors, because that's always the one wild card one would not want to continue to seep in one's portfolio. So that is good news. The big question in the markets today is what Scott mentioned: is there a recession as a byproduct? The bottom line is our base outlook is one of what I would call a mild recession, and that's not trying to hedge your bets. I'll share with you just some leading indicators that effectively this debate between what some call a soft landing, which sounds like not a recession, and a mild recession are effectively the same outlook. So this is economists debating amongst themselves, and I would try to bring clarity to say we are tracking at modestly positive growth. It will seem like 2001. If you recall that, it was the unwind of the dot-com era, another period of low interest rates at a time, and there was some modest rise in unemployment rate, but it was not the sort of deep recession that certainly would be concerning like we saw during COVID and we saw during the GFC. No one has that expectation, certainly I don't. And so there's just a debate in terms of shades of weakness over the next 6 months. So I'll share with you a little perspective. And then finally, the big unquestioned positive is in part because of our diagnosis of the labor market, and that inflation is going to come down, but it will be sticky because the labor market is still likely to remain tight, even with a mild recession as the baseline. This makes, in our judgment, certainly in my judgment, very unlikely the Federal Reserve is going to cut rates over the second half of the year, which the financial markets seem to be craving. I think part of them are looking at the previous decade of easier money. If I'm right, then we won't see the need to cut rates. That is ultimately a good news story for the financial markets and for long-term investors. So if I'm a fiduciary thinking about a long-term portfolio, the best thing I could cheer for is an interest rate that's above the rate of trend inflation, because that compounds over time. And so we see that. So really briefly, Zell, I would just go to slide 2, just in terms of the projections. Yeah, on the next slide. There's just a really high level in terms of the right-hand side. The blue line is GDP growth. So that's what economists focus on is the central statistic for is an economy expanding or contracting. And the gold line is the leading indicator. Vanguard leading economic indicators, over 100 indicators at all. Other firms have similar ones. And the picture is fairly clear, is that you will continue to see a deceleration. You see the rapid rebound after COVID. It almost changes the scales on these pictures. And you see that it's pointing close to zero, if you can suit your eye on the circle. And so I draw that parallel to 2001. At that time, there was a debate if actually it was a technical recession or not. It ultimately was declared a recession, but GDP growth actually never went negative in a formal sense for the calendar year. We have a similar sort of, as best we can estimate, similar outcome in store for us. So these titles of mild recession, you may hear job flow recession, is even something I've referred to, softish landing. I'd say broad brush, they're all effectively the same outcome, and it's not the worst outcome. It would suggest that we have some more weakness in store in the next 6 months, if history is any guide, because most Fed of the tightening has not been fully felt in the economy. But I'm not being alarmist. I think if this outcome, we have like a 2001 slowdown, we may have some volatility this year, but it would, given the amount of inflation we had last year, that actually would be a fairly good outcome from a Federal Reserve perspective. And when we look at Europe and China, Europe is in very much the same boat as the United States. This is the same sort of picture of leading indicators along with the GDP growth. You can see how the blue line, which is the leading indicator, is below GDP. It suggests that there's more weakness ahead. But if you just look at the eye, it says Europe will trend around zero. And the line is starting to improve a little bit on that leading indicator. So you see that in the financial markets. Zero is not the worst outcome. Again, if you think about the Ukraine events, the natural gas prices, but it does say that we have not seen the full, we're not out of the woods on Europe, and that we still have more weakness in store in the actual economy. These indicators are they give you a 6 to 12 month lead time on what actually transpires in the actual economy. China is a different outlook. It's clearly rebounding after their COVID policy of containment this time last year. It was a significant drag for their domestic economy. It dragged on commodity prices despite the high inflation. And we will see our leading indicators pick up significantly. And it will be one of the few economies in the world that will be accelerating over the course of 2023. And actually, maybe another reason why inflation actually may rear its head after coming down a lot in the back half of this year, given they're coming out of COVID. So in terms of inflation, and then I'll probably end my comments. Inflation, these two lines, the gold is what the trend inflation rate is in the United States. Apologies for the small numbers on the axis, but I don't think we need the axis to tell us it was a rapid rise. You would go back 20 years, it's the same picture. It is effectively around 2%, and then you see the big jump last year. We all felt it. We're still feeling it at the food store. And the biggest thing that we have been focusing on, I've been focusing on for more than a year, inflation will come down on a trend basis, which is what this core inflation measure is, if wage growth also cools, which brings us to the labor market. But this suggests to us that inflation will come down. That's why I put an arrow at cresting. And it will come down through the rest of this year. That will feel very good. The markets are anticipating that. But I think we will run into some resistance. I'm a little bit skeptical that all the inflation will disappear, because that fundamentally assumes it was all supply related. But I think many on the call, if you've tried to hire workers, if you know how tight the labor market is, this is not simply supply constraints. There was a significant demand rebound as well. And so if you even put part of that to demand and the wage growth numbers, it means that we will, back half of the year means that we will still feel a little bit tight here and there, unless we're wrong on our growth forecast and the labor market materially weakens, but we do not anticipate that. Most don't. Most of the job weakness will be confined to three sectors of the economy: IT, parts of finance, and e-commerce, because they were the three sectors that significantly overhired during COVID. Most of the rest of the economy is actually still underemployed, leisure, hospitality, relative to where they should have been if COVID had never occurred. So it's an unusual labor market right now in terms of where some of the excess capacity is. So this means that inflation may be a little bit stickier than some believe, but we're not going to see that stickiness for a little while. It will continue to come down over the next several months, which finally leads me to conclude in terms of central banks and interest rates. Scott, you mentioned the risk-free rate. These are the pictures of the risk-free rate around the world. I just picked several of them. The biggest thing in my mind was 20 years of near zero. And in some markets, negative. I mean, I learned in school interest rates couldn't go negative. We started projecting negative interest rates when we do simulations for clients 20 years ago. I thought it was an error in the computer code. It turns out it was actually possible, but I clearly didn't think so. The clear positive is not only are we exiting that, now we had to, given the tremendous inflation we had, but I do not think we are going to see rate cuts if we have an economy that stalls for a period, but inflation comes down but remains a little sticky. The good news, if I'm right on this, there's a lot of focus in the market of can central banks, once inflation comes down, cut rates to half where they are, kind of like the good old days, as if the past 20 years were all great. I would suggest, and our analysis points to the fact that we're entering somewhat of a newer era, and this has been a gradual glacial process, and that interest rates are going to remain a little bit higher than they have in the past 20 years. And that's good because that will ensure two things. That will ensure, one, that rates stay above the rate of trend inflation. Let's say the goal is 2. That is good because that almost guarantees over a very long horizon, almost guarantees, that real returns for investments in Hamilton Lane portfolios and risky portfolios over a long period of time, they will compound at a rate above inflation, which I think is really important for any endowment strategy. And then secondly, that also points to the fact that this concern that inflation risk is secular, not transitory, that significantly reduces the odds of inflation coming back, because some point to, like, it feels like the late 1960s, like inflation's coming down, but is it really dormant? And so I think if central banks look at this chart and focus on their sort of pole star and keep rates above the rate of trend inflation and not be in a race to cut rates with modest weakness, that would be the best news for investments. And I think the bond market's starting to price in this possibility, which is why our expected returns are finally starting to rise for the first time in several years for long-term clients, whether it's a 60-40 or an all equity or an all fixed income portfolio. So again, we're not out of the woods yet, but this is something I don't think gets as much attention, but I think it's a very positive for the financial markets. And as a long-term investor, I'm glad to see the zero bound starting to recede from recent memory. So I'll pause there.
Joe, I guess one of the risks is that central banks over tighten and do take us into a recession. And of course, that continues to put pressure on the capital markets. What is the risk of that?
Well, that is a risk. It's not a really high one. I mean, a modest recession effectively implies that you're over tightened, but that's just a trade-off to getting inflation down. You have to, in the end of the day, I think central banks have to pick inflation getting under control. And then there's this debate of how much collateral damage is done during this process. If we see worse than expected negative growth, then that tells me that it was too heavy-handed, but that would be very much a surprise to me. I would characterize that as it's possible, Scott, but I don't have a high probability of that because of the labor market. And we do not have the significant imbalances consumer and in the private sector, unlike we did during GFC, which was a completely different, can of wax. So.
And Mario, what are you focused on as we enter 2023 in terms of the global economy and its potential impact on the capital markets? And you might even comment on a couple of wild cards, particularly the war in Ukraine and its impact on Europe and and China's geopolitical goals?
Sure. I mean, it's interesting. I think our core view is very similar to Joe's, which may be a bad Joe you want to rethink his. But I think that from the point of view of the private markets, the thing that's extraordinary to me is a year and a half ago, if we'd have all sat here and said, hey, we were all worried about valuations. Valuations were too high. The markets were too high. They were running away. You couldn't make money because things were too expensive. If we'd said they're going to correct 20%, everyone would have said, that's great. Then I can buy at cheaper prices. So we corrected 20% and we're all freaked out and we're all kind of running around going, there's no hope anymore. I think this cycle will be very similar to other cycles. I think it'll be very, very similar to the 2000, 2001. In the private markets, you're going to have a period where pricing equity is really hard. No one wants to sell at prices that are lower than they were a year ago. But credit, you'll have a lot of opportunities on the credit side. You'll have a lot of opportunities on the secondary side. You'll have a lot of opportunities with companies that need money. That's how these cycles have all played out. And I suspect that's how this one will play out. There are going to be some amazing places to invest with companies that basically need money. Companies that don't need money are just going to sit this out and wait to see what happens over the next 6, 9, 12 months. And that's what I think you'll see in the private markets. I mean, look, private markets have traditionally most outperformed in periods when public markets are down or flat. And if you're telling me that that's the environment we're going into with kind of, so public markets, I'm happy as a private markets person because the public markets aren't going to be running away from us on valuations. Within that, to the things you cited, I think from the private market perspective, Europe, we think will be a little tougher because the war in Ukraine is likely to go on for another year. I just don't see either party really at all willing to change their position. And I think Europe is at greater risk in terms of what's going on there. It's so close, the proximity. The energy question in Europe still is not resolved in terms of what are they going to do? What is the transition going to look like? So I would say Europe from the private perspective, because you can't sort of bounce in and out, is a little less attractive today than the US. China on a relative valuation is probably as cheap on the private side as we've ever seen. There are probably good reasons for that. Certainly geopolitically, I think a lot of US investors in particular are concerned as to what politically might be done with Chinese investing, and they're a little wary of that. I mean, you had 4 years under Trump where you just didn't know. I also think with China on the private side, I know I'm a private person and private rocks and rules everything. I think right now you might want to go public more in China than private, just because I don't know what the exit environment will look like. I don't think it's at all clear today how China will regard private investment in certain industries. I think we're still going through that discovery process of what was a very negative environment from that perspective. So I think we'd be a little cautious on China on the private side, not because of the macro picture, but because of some of the dynamics around how you invest privately.
Mario, you oversee over 900 billion of private market assets or supervise, and there's been a bit of a democratization in the private markets and being more accessible to smaller investors or even individual investors. Maybe just talk a little bit about, because our investors haven't done as much private investing. With your help, we're encouraging them to do so. But maybe talk a little bit about how investors should approach developing a private markets portfolio.
Yeah, look, again, bias. I think, and I've said this, and people have hooted me off webinars like this. I have said that over the next 10 years, many investors will have up to 50% of their portfolio in privates, not just equity, but private credit, private infrastructure, private real estate, at a core reason because it outperforms. So here's an interesting stat. Last 22 years, private equity has outperformed in 22 of those 22 years. Up, down, markets, doesn't matter. Private credit, 21 out of those 22. Pretty good track record. Will it continue? I imagine, I don't know, but 22 out of 22 is a pretty good record so far. So I think what investors need to understand is privates have a place in your portfolio. You can debate whether Mario's, doing something that he shouldn't be doing and says 50% and he's crazy, maybe. But it is something. You talked about the 60-40 didn't work this year. It didn't work for peculiar reasons, but I think it also didn't work because you need to have privates in there. And so I think investors need to say, how much private do I want? In what areas? You have a million ways to invest in privates at this point. You can do it with long duration assets, shorter duration. I mean, there's just a lot of ways to do it. I think people need to understand that liquidity is a risk, but you probably overrate liquidity as an investor. You want liquidity for all the wrong reasons. You want it so you can get out when you shouldn't and get in when you shouldn't. I mean, that's sort of why people want liquidity. And so that to me is how you need to be thinking about putting it into a portfolio. You need to do it over time, and you just need to understand that it is a portion of your portfolio that you're not going to worry about quarter to quarter. And I think it varies for each individual investor as to how much and what form. But I think this trend of saying, I'm not going to look at the world as just the public world. I'm going to look at it as public and private equity, public and private debt, public and private infra. And that's how I'm going to fashion my portfolio is here to stay for institutions, high net worths, individuals. I just think that is where the world has been going and will continue.
I think you've answered this, Mario, but a question that's come through from our audience is, what does private equity look like in a risk-off environment?
Well, I think it looks great. So when Joe showed the chart of 2000, I think we would have been having this same discussion. Remember, a lot of people don't, but the dot-com world had collapsed. Everyone was sure investing was over, particularly in the private world, and risk off. And if you were investing in privates at that point, particularly kind of boring buyout stuff, you had a phenomenal 5-7 year run. I'm not saying that's going to happen again, but I'm saying when you look at how the world looks, you'd rather be investing today than you would at the end of 2020 when people couldn't invest enough.
Joe, just a question on how would you rate the odds of persistent negative real rates as a way to manage the government fiscal situation?
Well, I think that's a great question, Scott. And I think that's every sort of period is somewhat unique or evolves. And I think this sort of implicit lack of tension between government and the debt levels, so I'll call it Treasury, Congress, and the Federal Reserve, who's independent, they were generally aligned for different reasons, right? Inflation was too low, you keep borrowing costs low, and then many times below the rate of inflation because they're trying to get inflation up, right? So that was negative real rates. That helps if you're expanding your debt supply. Right. Some would argue that the tables are slowly turning just secularly on higher inflation. I think that's debatable, assuming we have rates above the rate of trend inflation, which still should be 2. So that tells me that the neutral rate is higher. That then there's going to be a greater tension because that means a higher borrowing cost for government debt. I think that's one of the small reasons why we're seeing somewhat higher real interest rates at the long end of the Treasury curve. Part of that could be liquidity, inflation risk premia. I think real rate premia, which is a fancy way for saying bond investors want to start taking out a little bit of insurance for the debt trajectory, because structural deficits matter. Near-term deficits shouldn't matter because they're viewed as temporary. So I think that is going to be a tension. Scott, I'm not out here to say we're going to have this significant crowding out and we're going to have a fiscal crisis, because that's a tough scenario to generate, because what's going to replace the Treasury? U.S. Treasuries in the near term. That's how you get markedly higher fixed income cost outside of inflation. So that's a longer term sort of scenario to consider. So I'm not complacent on it, but I think you can coexist. But I think maybe that's good for fiscal discipline. A little bit higher sound money introduces more serious trade-offs, like such as Mario, between private and public, or stocks and bonds, or risky assets, non-risky assets. So I think this is going to be a more, in that sense, hopefully a more normal or balanced environment going forward.
Why don't we talk about energy prices for just a minute? Because, it's a major sector. They had a tremendous year last year, energy stocks. after years of not performing very well. It feels like the ongoing war in the Ukraine will continue to push up energy prices. It might also accelerate the green transition, especially in Europe. But just any comments at all on energy prices going forward? Mario, do you want to maybe take that?
Yeah, energy is an interesting thing. You alluded to some of the questions on the private equity side. The whole ESG movement, particularly outside the US, has made holding energy assets, particularly fossil fuel assets, a really bad thing. I would say that the private equity industry as a whole was very much underexposed coming into this cycle to fossil fuel energy assets, both because many of their investors didn't want them to hold it, but also because, let's say I want to buy a Permian Basin asset. I don't know who I'm going to sell it to in 5 years, given kind of the pressure around these sorts of assets in portfolios. So I think that will continue to be the case. Investors don't want it. GPs don't really know what's going to, it's like coal 15 years ago. It was cheap, but you just didn't know what you're going to do with it. I think the energy transition piece, I agree with you, in Europe is going to be a place where you're going to see an enormous amount of capital flowing in, both from a technology perspective, new technologies, from an infrastructure perspective, wind farm, whatever you can imagine, and buyouts. So I think you will see a lot of ESG impact, energy-oriented investments in those areas. And I suspect, contrary to what I said before, Europe will be the most interesting place. Europe will do an energy transition before the US, probably before parts of Asia, because they have to. They have no choice. They just got rid of their cheap Russian energy. So I suspect energy prices will flatten, particularly if Joe's scenario is correct, with a macro environment that isn't really robust. But I think they'll go up for some period of time because we're not investing in fossil fuels. And I doubt the energy transition will happen quickly enough. You're going to have this weird period, and I don't know whether it's a year or 10 years, where you're just not going to have enough energy. You've seen the Saudis have said that, hey, people, we're running out of, we can't. You look to us to put in another couple million barrels a day in oil, it ain't there. So that is going to be one of the things we're all talking about over the next 3 to 5 years, is how quickly are we transitioning and what are we paying for it? And from the private perspective, I hate to say this, but that's a great place to be, because you can be investing in a place that now has a fundamental economic driver behind it.
Joe, do you want to add to that?
Yeah, I'd say two things and I agree with what Mario said. I mean, just history would show, if this is the world's third energy transition, right, roughly from wood to sort of coal to electricity. Now it's electricity source A to electricity source B, I guess. Two things, at least if history's any guide at all, two things. One is what Mario said, the fuel that's being replaced does not necessarily drop in price. In fact, most commodities, for whatever reason, if they become less used, lead, mercury, tobacco, they all have actually held up in price because there's less supply invested in it. It's everything Mary said. So, okay, the demand curve may be coming down, but the supply curve is moving in, which means you can hold the price up. Coal is the same thing. Now, which force wins? But it's not surprising, although that may sound like a surprising claim I made. It's actually not surprising when you see the lack of investment. I think, secondly, that's the only risk of avoiding certain sectors from an investment strategy. So even in ESG, some basic screens exclude all energy. The only caveat is that we have to effectively fundamentally change how we generate energy on this planet over some long period of time. So the innovation and so forth and the capital required is a lot. And so that's just something just to be thoughtful and mindful of. I'm not saying one wouldn't do that for moral reasons, but to try to minimize the sort of screens one's doing in one's fiduciary standard, because there's a lot of transformation that needs to occur. And it's unclear to me which technology wins and which companies pull that off. But there is risk to being thinking about the energy transition, I should say, again, a one-step process. I think Mario was saying it's a multi-step process on this.
It's certainly an important issue for Catholic investors in thinking about climate change and the Pope's encyclical and Laudate Si, et cetera. So we get asked a lot of questions about the sector. Shifting gears, we had a question about the best and worst case scenarios if Congress does not raise the debt ceiling. So I'll throw that out to you too.
Joe, the best and worst may be the same scenario.
Yeah. What happens?
Well, I would hope public officials extend the debt ceiling, and then at some point also have a conversation of how we want to balance expenditures and revenue. If we somehow don't extend it, my best guess would be we actually have bond prices go up, not down, because of the volatility introduces and the risk off, which is a really bizarro claim, but we've seen this in the past because the US is the world's reserve currency and the largest bond market. Anything that sounds bad economically tends to rally into high quality fixed income. So I hope we don't cross that bridge, Scott, but it seems to be becoming an ongoing sort of commentary.
I would just add a little broader. In the private world, what we have seen over the last 5 years is in deals pricing political risk or trying to judge political risk, and not just in the US, but everywhere, has a much higher priority or value than it has before. I don't remember as many discussions around political risk, whether it's China and, like I said before, certain industries that they basically just take, they're gone. And from a private investment perspective, and you just didn't have it like that before. Places where you didn't think you had political risk. In the US, political risk around macro and even some micro. In Europe, Brexit, you have things that have all of a sudden become more important than some basic economic fundamentals. You spend more time on that than you spend on whether there's going to be a recession. When in the last 35 years has that ever been the case? But I think that's part of the reality of all of us as investors now, where this whole political polarization, we can debate good, bad, how we deal with it politically, but from an investment perspective has a real implication, again, in the illiquid markets in particular, because you can't go, oops, I got it wrong, I'm going to get out tomorrow and live to fight another day. I've got a company that now China just said, sorry, we don't want you to invest in that anymore. Tough. Yeah.
Speaking of political risks, we now have split government. Historically, the best markets have come when you've had a different party in the White House versus dominance in the legislative branch, and I guess particularly a Democratic president with Republican control of the House and Senate. So we don't exactly have that, but this does bring in the debt ceiling issues, and the government's total debt comes back into focus. Higher interest rates, payments on debt, et cetera. Just any thoughts about the current political landscape and what this could mean for policy going forward the next few years?
I'll give it a shot. I'm a big believer in split government because you're right. Yeah. It's always been good. The issue here, to me, and again, not just the U.S., but you even see this play out in some of the European countries, is it is split government with too many people on each side very willing to jump off the cliff. And I don't think we've seen that before. I think the thing that is different from 5 years ago, 10 years ago, is that compromise is a dirty word now in all of the parties. Like it is a mark of weakness. It's a mark, you never want to be compromising. So I do think we've gotten comfort in a split government because they kind of have always either not done anything, but avoided catastrophe or met in the middle or somewhere. And my worry is we have a split government with enough people who don't want to meet and don't want to avoid a catastrophe because they win from a catastrophe. They get reelected. It only takes 30 of them to believe that's going to get them reelected. That's different, and I think a little more worrisome than what we've had before.
Anything to add, Joe?
No, I thought Mario's characterization was great. You know, there's less compromise or bipartisanship on certain issues. I mean, that's clear, which means you see less legislative action. That could be good if you think that policy may be troublesome or alarming, but it particularly makes a risk if we fall into another crisis, geopolitical or otherwise, right? That's the one wild card.
Mario, we have a question about private markets, and with many investment managers having known a very low level of nominal rates during their career, how do you assess the risk of the private industry not being ready to be working with much less leverage?
Yeah, I think the question is a very good one, and one we spend a lot of time on with managers, because it's correct. It's not only lower rates, it is 15 years without a bear market. It is 15 years of people who think all I got to do is buy an asset, and I may have a bumpy couple of months, but what the hell, 5 years later, I'm good. And that is really new. So we, for example, spend a lot of time looking at teams and whether they're composed, and there's actually people involved and engaged who've been through cycles, because I think that to me is a very critical feature of anyone you're going to be backing. Have they seen a cycle, or at least the people that are making decisions? So that's one. I don't think the level of rates, at least that we're talking about today, are a real problem for the private markets. If you tell me we're going to 8, 9, 10%, and the Fed pushes rates there, okay, we're in a different ballpark. But again, the chart Joe showed was great. This is where we've been at rates for, before the last 15 years. And sure, we all got kind of addicted to the low rates, but it doesn't mean that the central thesis around private equity, for example, which is some amount of leverage at a reasonable interest rate, which we have, and operational improvements, which we do whether things are higher or lower rates. So I don't think at these levels, there's a whole lot of concern that the thesis around which private equity operates is at all challenged.
How about any black swans out there? What are some of the things that the two of you really worry about in terms of potential black swans?
I'll give one. Labor market doesn't slow down at all. Mm-hmm. So it's usually on the negative side, and Taiwan concerns me. But I'd say the labor market doesn't slow down at all. And the Fed's not stopping at 5.
Right.
Because of that. Not to be alarmist, I'm not saying 10% and we're 1980. It's just, wow, was it resilient? Higher real rates? I was right in the direction, but I underestimated the magnitude. It's still good longer term, but that means, because the market had that expectation stopping at 2, stopping at 3, stopping at 4. And so that's what keeps me up at night from an economist perspective.
That's probably not even that much of a black swan, right? I mean, that could happen.
Yeah, right. Maybe that's not completely crazy, right? But like no weakness at all. And the world of this low growth narrative was the GFC related, which I believe is true, and it was dissipating. But the world really changed post COVID in a way that at least I underappreciate. And so thinking about that going forward.
I had one manager give me a black swan. This was a European manager, and this was 6 months ago, so they were probably more depressed than the average bear. And Joe, I'd be interested in this, but they said what their black swan is: we got it all wrong, and we're going into another disinflationary environment, and it's going to happen really fast. That all of this worry about inflation is going to disappear because demand will fall off a cliff, the supply chain issues get solved. The debt never really got dealt with, and boom, now we're in disinflation, and the Fed and the central banks will be equally slow as they were when inflation was roaring, and they'll just sit there for 6 months, and then we're now back in the 09-10 environment.
Mara, that is, I think that's the inverse of the black swan I was talking about. So one is Fed has tightened, but the world changed. it's really higher. It's like 1990s type levels. I don't believe this, by the way, but like we don't see any slowdown in the labor market.
Right.
Yours is the opposite. World didn't change at all. We got a supply shock with some fiscal thrust. The world didn't really change. And so the Fed's going way above where they should be. And they're going to look like Wile E. Coyote above the cliff. And we're going to drop down. So either one is uncomfortable because the financial markets have to reprice to that.
Yeah.
I don't think, but yeah, I think that's the inverse of. So now I'm going to get even less sleep because now I got to worry about both of those. But
which would you worry? Which would you worry about more? Like, which one would you say, that one really gets us in a very bad place?
I worry about yours more, Mary. I would be more concerned about yours, Mario, just because of the long compounding effect. Yeah, we can get so much stronger financial returns through the leverage and the gearing, maybe valuation multiples, but the discount rate came down. So we just took off expected returns, and there was some, it was lower growth the past 15, 20 years. It was not most equally distributed.
Right.
And so I'm not saying that COVID completely changed the world into a more magical place. I just think some of that was starting to recede. I would be chagrined if there was no improvement at all. I wouldn't like to see that. We go back to those pre-COVID charts, because that's symptomatic of a little bit more of a malaise in the industrialized world.
Yeah.
Let me go to some of the questions that we have here. Here's a good one. What are some of the most interesting areas / technologies you're excited about investing in over the next few years? Mario, what are you hearing from some of your managers?
Yeah, I mean, we alluded to a little bet of this earlier. AI is certainly an area people are investing in. It feels like a make or break, like you either get Chat GPT and you're worth $50 billion, or you're kind of laboring in Mario's garage somewhere doing something. But there's certainly a lot more interest in the application of it to various industries, to various jobs, to various sectors. The energy transition we talked about from the technology angle. I don't think there's a fundamental shift from the last year and a half. I do think people still believe that there are healthcare and I'll call it software, things that are still, the world has not changed so much that those areas are not going to continue to grow, that the world population is aging, that you need more productivity to, just all the things that we talked about a year and a half ago before we thought the world was different. So I think that the interesting part from the private perspective is what is changed is you not only have new companies you can work with, but the haves and have-nots in existing companies is going to be dramatic. You're going to have companies that are really good. Remember, I think with Google, didn't it form out of the great financial crisis?
Yes.
You have companies that will need money at lower valuations than a year and a half ago. And I think there's going to be really good areas to figure out, there's one I'm going to invest. And there will be companies that simply go out of business because their business model just isn't going to fly. So I think much more kind of diverse outcomes, but a lot of stuff will be going on in that space over the next 2, 3, 4 years. But I think fundamentally, you're not talking about a completely different environment from a year and a half ago.
Yeah, I agree. As a chief investment officer, I always felt I could bet on innovation, particularly in the U.S. and China.
Yep.
I think, and increasingly Europe now. There's so much to do. And by the way, the tools for innovation are cheaper, more accessible, than what you go back 30 years to the mainframe environment when it was very capital intensive. So I really believe in that. And what I would always describe is I want to be with companies on the right side of change. So the things you talked about, Mario, in addition to AI, things like the cloud, the internet, even fintech. I know that crypto is a bad word right now, but fintech means a lot more than crypto. And if you look at industries that are very bloated, are using old technologies. I mean, the major banks in the country are still use COBOL technology in their systems. There's a lot of intermediaries. There's a lot of middlemen. There's a lot of ways that could be more efficient. So things like blockchain technology are here to stay.
Yeah,
still
absolutely.
Right?
Blockchain now, like you said, has a bad name because everyone says blockchain's crypto. It's really not. I mean, crypto uses blockchain, but blockchain does much more than crypto.
Joe, do you have any thoughts on the areas investors should be thinking about?
Well, I'm not, I don't have either of your expertise. I'll just say that, the indicators we look at to try to predict commercial innovation from a macro perspective, which is kind of it's a tough exercise because economists think it's unpredictable, but we have been able to look at, academic research in terms of signals of what the future lab ideas are coming. And when we did that a few years ago, two fields popped in the same way that computer technology popped in early 1990s. So it said it was coming. Now, we couldn't have told you the company or whatever. If I did, I would already be tired for Vanguard, right? So I need Hamilton Lane to help me out there. So the two areas that said it 3 years ago, and it takes 5 to 7 years, one was biomedicine. It was the same thrust in terms of influential ideas exponentially growing that are valuable. They're being cited by others and leading to new ideas. So that's how we lead and indicate. We look at every published article in the world, everywhere, at every point in time. The other one was around AI. I would call it computer. There was smaller signals in battery and in food. I don't know what it is going on in food. That's just another area, but they weren't rise to the level that I think you and Mario are talking about, Scott, that are more like general purpose technology changes, which is reason to be optimistic for growth. So I would be looking at healthcare and AI, fundamentally changing how we work and how we live. Because if they don't hit one of those two boxes, it's not truly transformative from a macro perspective. So I'm actually encouraged by the future when I look at that, because I think you're mentioning two potential general purpose technologies, not one.
Yeah, that's very good. Question, Joe, any chance the yield curve goes back to a normal shape in the near term?
I would hope so. That's our forecast. But I think it's because the long end kind of gives out a little bit. I don't think the Fed's going to raise the cut rates anytime soon.
Yeah. How about any, just a couple questions related to any contrarian risks and opportunities that they should be looking for? Anything we didn't mention? Any contrarian risks or opportunities? Talked about a few things, but
everything's been blown apart, I guess.
Yeah.
What's contrarian?
Yeah. There's a question on ESG, and we're just about the end of our time here, but there's a question on ESG, and let me just pull that back up, because it is something Catholic investors are thinking about. As Catholic investors, I'd be interested in your opinions on the recent politicalization of ESG investing, and whether you believe that investing according to Catholic values limits the opportunity set and impairs potential returns. I could cover, go ahead, Mario.
No, go ahead, Scott.
I was going to cover the last part of that. I don't believe it does. Many of these businesses are not particularly good businesses. There's all kinds of substitutes. It's not something I ever really worried about because it was so inherent to what a Catholic investor does. It's not I got to do this, but gosh, I have these limitations. No, we got to do both. Yeah. We got to do both, and we got to do them well. And so I think there's a lot more product available for Catholic investors, for faith-based investors that have the appropriate goals and screens, if you will, the mission sensitivity than what we had, 20, 30 years ago. So I think it's getting easier. There's more services available to identify screens of companies that violate, whatever ethos that you're tracking. In our case, Catholic social teaching. So it's not something that I really ever worried that much about. And even in private equity, these are not typically businesses that are going to violate faith-based investors, right, Mario?
No, we just haven't seen it be a problem nor impact returns. Just like you said, there are a lot of choices. The other thing with, and it gets to the I can't say it either, the political aspect of ESG.
Yeah.
One of the things that is difficult around that is the issue for ESG is both the proactive, but also the risk issue around ESG. And it always worries me when someone says you can't use something as a filter to look at investments, because I get that some politicians are saying, I don't want you to do that because it takes away that. But there's a risk around you have to consider it. Some of these companies will not be companies people want to be investing in 2 years, 3 years out. It was what I was talking about with energy. It's the risk issue of what happens if socially people turn away from a company that offers this product or service that is now not desirable. Your investment will not, and if you haven't considered that from an ESG perspective, you've missed something. Make your own decision, but I think it has to be part of people's investment decisions. I don't think it is appropriate to pull it out completely and say, no, you can't consider it. I think that's as bad as forcing it as a consideration and saying you will consider nothing else. I just don't see that that's a way to be going from a fiduciary perspective.
Well, Tom, we covered a lot of ground today. Any last questions or issues we want to bring up?
Well, I don't think that any of the three of you are in any danger of being replaced by robots yet. So just let me add my thanks for a really terrific discussion, and I know our audience got a lot out of it. And but to our panelists who took time today to be with us, and Joe, you may have earned a new recurring role for CIS, but really thank you all, and thanks to our audience for joining us. And please, if you have time, fill out the audience survey that follows the call. And I hope that you're all healthy and safe. Zayla, anything to add before we close? Great. Right.
Thank you all very much. Thank you, Joe. Thank you, Mario.
Bye-bye.
Bye-bye, Mayor.